as I mentioned, well, wouldn't you know it? It's like I'm psychic, right? I mentioned convertible bonds, and now here they are. A convertible bond is the same as a normal bond in form. However, so it's a fixed income debt security that pays out interest, right? That's a normal bond. However, this convertible bond can be converted into a predetermined amount of common stock shares. So maybe, a $100,000 bond pays out 10% interest, blah, blah, blah. But in addition to all of that, I can give this bond back and now get 100 shares. That's just a stipulation of the bond. That's just another incentive for me to buy the bond. Maybe the stock is now increasing in value and I want the shares instead. Converting the bonds to stock can be done at multiple different periods of the bond's life at the choice of the bondholder. So that's how this plays into diluted earnings per share. That's why it's important. Well, let's see an example of converting that debt to common stock, right? So we have a convertible bond. We're converting it to common stock. Conversion of debt. Let's see what we've got. Well, ABC Company issued one $1,000 bond to Park Company, issued at a $45 premium. Now, here's a good point where I'm going to say, if you haven't seen the bond section yet, I would skip over this example until you have reviewed the bond lecture, right? There's only so much we can do, right, in terms of putting this in order of everything, because there are topics that intermingle with each other. But follow along best you can. Premiums and discounts on bonds, that's something you'll see later on. This bond is convertible, and the rate is one bond for 10 shares of stock in ABC Company at a $10 par value. At time of conversion, the unamortized premium per bond is $30. All right, so what happened originally? ABC issued the bond for $1,000. Now, from the bond section, if you remember correctly, if you've seen that already, well, you would have credited bonds payable for the face value of that, right? The clean number. So now you're reversing that out. You're debiting it. So that takes care of the debit. You're reversing it out. You would have credited the premium. Well, the unamortized premium at the time of conversion, you need to now take this $30 and debit it. Get rid of it because it doesn't exist anymore, right? It was converted. So that takes care of our credits. Those are the portions of the bond that we need to essentially remove. We're backing them out. It's kind of like an adjusting journal entry. Common stock, what is being given for this? Well, 10 shares per one bond. There's only one bond at a $10 par value. Common stock for the company is going to be $100. And APIC, well, APIC is the plug, right? It's also the amount over par value that the company is going to recognize essentially as a quote unquote gain. So this is the journal entry for when a company actually does convert that bond to common stock. Again, if this is a little intimidating now, don't worry. Go take a look at the bond section, maybe also at the equity section. Come back, take a look. It'll all make sense. But don't worry about this. This is not critically essential to what we're going through moving on forward here.